What is up, Steve here. I hope you are doing well, and depending on when this video comes out, happy 4th of July. I hope you and your families and friends all get together and enjoy each other's time and really reflect on what's going on in this country right now. You know, there's a lot of things going on in the United States as well as across the entire world. And, you know, the United States still is one of the most free countries. That equates to a lot of opportunity. And even though, you know, a lot of our freedoms are being kind of snatched away and it's dissipating some, we still have ample opportunity to do a lot for ourselves and our families, as long as we're strategic and we're educated and not necessarily watching these politicians and these mainstream media yahoos out there just spitting all sorts of nonsense and making people believe a false narrative in many cases. So this article that I want to talk about today, and I'm going to put a link for Harry Dent's YouTube channel as well as his website that you guys can sign up for. I think there's like an annual fee for this guy. I think I paid like a couple $100 for the year. Anyway, this guy, he studies demographics and he studies economic outlook, and he's been right on several different fronts in terms of really timing markets, and he's actually pinpointed many ups and downs, whether it's in real estate or the stock market. Just a very bright guy, and he's saying that most people are not saying. He's more in line with you know, somebody like Peter Schiff in terms of where he thinks the real estate market's gonna go. And it's very interesting, because I was saying something similar, because we never, with the great financial recession, which I think this is going to be way worse, we never fully recovered from it. And I said in other videos, in terms of 2019, you know, if we were in a healthy economic state, the Fed wouldn't have reduced the Fed rate right prior to the pandemic. And it was just, the real estate market was limping along. Everything was just limping along. And, you know, there was still stimulus in the economy until, you know, leading up to the pandemic, which exacerbated everything. So let's talk about this article real quick. It's a 12-page report. There's a lot of information in it as well. I'm just gonna kind of review some of the highlights and we can talk about it. It says, look at this chart, which clearly shows the first bubble from 1996 into 2000 in housing, the 34% crash, which was greater than the 26% crash from much less of a bubble in the 1930s, and then the second bubble from 2012 into 2022. In both of these bubbles, there was an equal 2.2 times gain in value of housing in 10 years. Housing normally goes up with inflation at a rate of about 2 to 3% a year, so both were clearly a bubble and equally so. I mean, the chart that I just put up, there's no denying that. There's no denying that we have exploded in asset valuations, and it's not just real estate either. Moving on, the first real estate crash was 34% nationally, again substantially more than in the Great Depression. But look at what happens in this next chart if we project that the fall in prices in 12 major cities will go back to merely to their early 2012 lows. This is both the level I project that the real estate will drop, and also naturally the more likely the outcome. The leaders in the last bubble were southern cities like Phoenix, Las Vegas, and Miami. This time, Tampa, Atlanta, Denver, Seattle, and Dallas have bubbled in affordability more than its first bubble. And I mentioned countless times in this video, or multiple videos on this channel, that Southwest Florida, we experienced a drastic reduction in asset prices in housing. And you know, we were in more of a cyclical area in terms of that, in terms of a lot of speculation and everything else, but I think we're going to see it on the masses across the board. Harry goes on to say, just think how crazy it is for the same house in Phoenix to go up 3.55 times in just 10 years. Anyone who now says that this is not a bubble is an absolute idiot, and that would be a lot of economists. Now, I'm going to throw this chart up as well so you guys can see, and just it gives you the idea of where the housing market could go. And if you guys are on the sidelines like myself, I mean, we're still making some offers, but we got to get the right deal. But if you practice patience and just wait it out, this could be. So check this out. It says current price, Phoenix, Arizona, $476,000. The low of 2012, which it could be based on Harry Dent's analysis, is $134,000. Tampa, Florida, $375,000. The low of $119,000. Seattle, Washington, $795,000. The low of 2012 is $260,000. Atlanta, Georgia, $375,000. The low of $131,000. As you can see, the list goes on in terms of the highs and lows where we're at today compared to 2012. And he goes on, this is going to be much more painful than the 2007 to 2009 crash, especially to homeowners. One argument the real estate experts have used to say that we are not in a real estate bubble has been that lending is not as aggressive now versus in the last bubble. We hear this all the time. But prices are substantially more extreme in this second bubble after massively over-accommodating stimulus was used to starve off the 2008 crisis. This bubble burst will be bigger than the last one, and he predicts 53% by my best estimate versus 34% in the last great financial crisis. So what do we have now? A rapid surge to 8.6% inflation caused by the Fed's overreaction to COVID, which has included $5.1 trillion in money printing since COVID began, on top of the federal government's fiscal stimulus of $5 trillion. I mean, I don't even know what to say about that. By the way, the Atlanta Fed came out and they just basically stated that they believe that second quarter GDP is going to be negative. So they are predicting that we will officially be in, well, I believe we're in a recession right now. And if they're accurate in their analysis saying second quarter GDP, then we officially are in a recession. The Fed has been forced to raise interest rates and start reducing its highly stimulated balance sheet for financial assets. That means that the economy will slow and that financial assets will slow even more. If we're finally entering the next recession, it's likely to be either a Great Recession at a minimum, or more likely a final fast, deeper Great Depression, as it should have occurred in 2012 in the first financial crisis, except that this was brought to a halt by endless and unprecedented stimulus starting in early 2009, which has prevented the economy from cleaning house by getting rid of unproductive debt and zombie companies and getting healthier again. I don't think that there's a handful of YouTubers talking about zombie companies, and I've mentioned them as well. And to be cautious, especially if you guys are hired by one of these companies, and how important it is to really do your research to find out how stable or solvent certain companies are. But I think that I don't think that based on inflationary pressures that we're going to be able to stimulate even more, including bailouts like that they did in the last Great Recession. So I don't think that the money's going to necessarily be there. Maybe there's going to be certain companies that are going to get cherry picked to have a bailout, maybe certain airlines. But there's going to be I think that there's way too many zombie companies out there that are going to fall aside. And lastly, this crash has also been held at bay solely by massive artificial stimulus, and that means that it's more likely to hit harder and faster when the bubble finally does break. Central banks likely have lost too much credibility to double down again, and with even more massive stimulus, but that will be the wild card. And that is, we have people on this channel asking when is it going to bottom out? When is it going to crash? And that's what he's saying there is, and George Gaiman does a good job at this as well, where you know, for anybody to say it's going to crash, this is what's going to happen, this and that, I think the inevitable could get delayed, but at some point in time, we are going to have, I believe, a major financial disaster on our hands. I think that we probably will end up in a depression, and I think it's going to be way worse than anybody's anticipating. But when that's going to happen, who knows? Because again, the wild card is based on the decisions of the Fed, the central banks, and our government. So it's going to be really tough to try to predict something like that, but I think all the trends right now are showing that we're headed toward it. And with inflation as it is right now, I don't think that they're going to pump much more money into the national economy. I mean, you can look at states like California where they're just doing all the wrong things in terms of overstimulating. I think Californians stand to receive like $1,000 check right now. I mean, it's doing nothing but hurting the economy, and unfortunately, time will tell. But I want to end on this. I think that, again, if you guys are being prepared for a market crash, for a downturn in real estate, for a downturn in the stock market, and you guys are keeping your personal expenses as low as possible, you're stacking money, you're working on your credit, because we want to have as high credit scores as possible. We want to also have as high income as possible. I asked a question on another video about what your side hustle is, and you know, I appreciate everybody that has told me about their side hustles, and it's good because some people were able to pay off credit card debt, pay off car loans, and start stacking money. And the more income that we're showing, the more debt that we're going to be able to take on for cash flowing assets that are distressed, in my opinion. And you know, keep stacking cash and doing those things right now, because I think we're headed there. Anyway, I will see you guys on the next video. Have an awesome 4th of July weekend and stay safe out there. See you.